Hello everyone. In this video, I'm going to give you a general overview of alternative investments. You can always get more information by visiting our learning center at the HUDSONPOINT.com website. Now, alternative investments are financial assets that do not fit neatly into what generally is available to most retail investors like stocks, bonds, or cash. Basically, anything outside of the stock market. The most common alternative investments include pre-IPOs, real estate, private equity or venture capital, hedge funds, and private credit. These are typically institutional type investments since the minimum investment amount required per deal could be north of $10 or $20 million. Historically, large institutional investors like pension funds, including the New York Pension Fund or CalPERS, endowments like Harvard and Yale University, or insurance companies are investing a portion of their assets outside the traditional stock market offerings into alternatives. They tend to be attractive to institutional investors because they are usually uncorrelated, meaning their returns do not follow the stock market, so they have the potential to provide returns when the stock market is bearish. Because these investments are less accessible and less liquid, they are not subject to trends and generally considered less volatile to the emotional decisions that affect the public stock markets. While historically reserved for institutions, the Jobs Act from 2012 created new options for qualified investors to access alternative investments. We will now explore some common alternative investment products. First, private equity, venture capital, and pre-IPOs. Over the last decade, pre-IPOs have risen in popularity. No surprise when you consider the potential returns. Sequoia Capital earned a 50x return on their investment in WhatsApp, turning $60 million into $3 billion. The prospect of pre-IPO investing is compelling. Investing in pre-IPOs provides access to a private company's shares before it goes public, typically at a lower valuation than a future IPO. Previously reserved for institutional investors and the ultra-wealthy, recent legislation changes have provided access to pre-IPO companies. There are some risks to investing in a pre-IPO company. It can tie up your money for an uncertain amount of time. They often cannot be sold until the company goes public, assuming it does. Now, if the company goes bankrupt, you could lose all your money. Another asset class within alternatives includes commodities and natural resources. This asset class provides a non-correlated investment opportunity outside of the markets. Natural resources like oil and gas, gold, silver can be accessed by purchasing stock-like equities and funds. They are often used to hedge against inflation and have periods of time with uncorrelated performance, but are cyclical and quite complex for the average investor. Now, hedge funds are also a popular alternative investment utilized by many institutional investors. Hedge funds are pooled investments run by a hedge fund manager with a unique investment strategy or methodology. They use various tactics to earn active returns for their investments. Many funds have an open mandate and oftentimes use excessive leverage, complicated derivatives, and short selling. Now, they aim to outperform the public markets by hedging their portfolios, thus reducing volatility and drawdowns or downward risk. When it comes to investing in hedge funds, you need to understand how each fund, as a prospective opportunity, aims to generate a return as well as the risk they take to do so. Hedge funds typically require a significant minimum investment from $1 to $10 million or more on each. However, there are platforms available to provide access and reduce this large initial investment requirement. Another common alternative investment is real estate. Real estate has historically been a popular strategy for investors to hedge against inflation and may offer long-term growth over time. Now, real estate syndication may offer an alternative to investing solo. Instead of an institutional investor purchasing a multi-million-dollar industrial factory, many investors can put their money together to own a small part of that property. 1031 exchanges and qualified opportunity zones may provide tax deferrals while growing your portfolio. Now, studying how institutions invest their money effectively gives us some insight into how they are utilizing alternatives to potentially get above average returns. At the end of the day, you want your investments to outlast you and provide for generations to come, no matter what the stock market does. The Yale Endowment Fund presents an example of how an alternative investment strategy can potentially benefit a portfolio over time. The Yale Endowment helped pioneer alternative investing in hedge funds, private equity, real estate, and so forth. Over 3 decades, it outperformed the markets, most investment banks and hedge funds. They grew from $1.4 billion to $42.3 billion in 2021. They have done this while allocating less than 3% of their overall portfolio to US stocks and over 75% into alternatives. Yale targets a minimum allocation of 30% of the endowment to market-neutral assets, cash, bonds, and hedge funds. Such assets can possibly outperform in a bear market, but might underperform in a bull market. The university further limits illiquid assets, venture capital, leveraged buyouts, real estate, and natural resources to 50% of the portfolio. Yale's asset allocation is a lot more diversified compared to the typical investor who might only invest in stocks and bonds. Their use of alternatives over the years has helped them in achieving their goals and outperforming their peers. Now, there are some risks that you need to consider before investing in alternative investments. First, it can be difficult to determine the current market value of the asset. For certain alternatives, you sometimes have to rely on third-party valuation companies. Also, there can be limited historical risk and return data. Hedge funds, for example, can use many different strategies, some which have never been implemented before. They are experimental, and while some are very successful, according to Impaxis, in 2019, more hedge funds closed than opened. Another factor to consider with alternative investments is liquidity. While some, like gold, are relatively liquid, others, like real estate, are significantly more illiquid. Pre-IPOs, for example, possess significant liquidity risk with long hold times. While pre-IPOs can be traded through investment banks and other avenues, they don't have the liquidity of stocks until they IPO. However, not every pre-IPO goes public, and some might go out of business. In addition, there are potentially higher minimum investment requirements for some purchases. Some, like hedge funds, cost millions of dollars to enter. Lastly, many alternative investments require a high degree of investment analysis. Diligence is required prior to purchase. Even sophisticated investors with many years of experience can and do lose money with alternative investments. Now, as investors mature over time, so do their financial goals and investment strategies. Most want to retire comfortably on a stable income stream without worrying about the market or how the global economy will affect their livelihood. The biggest challenge investors face is the time and knowledge to manage investments. Alternative investment specialists can provide access to alternative investment opportunities by leveraging their network of professionals that assess the risk and return potential for many investments every year. By working with a network that devotes the time and resources to thorough analysis, investors can potentially access alternative investment opportunities to add to their traditional portfolio. We hope this gave you an overview of alternative investments. For more videos and blogs, please visit HUDSONPOINT.com.